Okay, so this is part 2 of session 15 of our loan program, going over Freddie and Fannie loans. So, all right, so any questions from where we were on our previous conversation there?
I think I might have missed, or maybe I just didn't write it down correctly, but you said that it was called Ready Cap, or it's like a Freddie and Fannie lender. Is that like the name for it is a Freddie and Fannie lender, or is it an agency lender? Or
Yeah, they are an agency lender. So there's multiple agency lenders that are delegated by Fannie to lend, or they have the authority to basically send loans to Freddie to be reviewed and underwritten on their side. There's just a bunch of them out there. And Eli is just he is at ReadyCap, who's just one of those groups. So. Yep.
okay, thank you.
Yep, no problem. Any questions on your side, Will?
I think I'm good.
Okay, cool. So yeah, so we were discussing kind of just, the lenders want to make sure these are good deals are going to go through. They want to have the experienced borrower or operator. They want to make sure they're stress testing it. They also want to see history on the property. So even though they're looking for that 90% occupancy over 90 days, and I don't know if you heard the term T12 in the video there. Basically, they're looking for a 12-month history. They're going to underwrite to a 12-month history on the property, a rolling 12 months. So it may not necessarily be a full year for 2022 or 2021. They want to see from basically, from at this point, we'd still be end of June to previous year, 12 months back, and just to make sure the cash flow is good. They also want to make sure that that the borrower or the operator has a strong personal financial statement, which is, I think you guys should be familiar with that form. Basically, it's going to give away net worth, liquidity. It normally has scheduled real estate included in there, but they'll probably want a separate scheduled real estate form also, and they'll want to see that the client's net worth is equal to the loan amount. So they want to make sure there's something to back it up. And then and that net worth doesn't necessarily need to be liquid net worth. It just needs to be, net worth. The liquidity, they want to make sure that the client has 9 months of debt service coverage. So that's going to be, normally they'll want to see the principal and the interest in there. Normally, even if they're just doing an interest only period on the loan initially. And that's also something to be aware of on these Freddie Fannie loans. They do have some interest only options. Not long-term interest only. It's normally a portion of the fixed rate. So if they're doing 5, 7, or a 10-year fixed rate, then they'll have a portion of that, and it's not automatic. It's just something that the borrower can request for. Any questions on that information?
Sorry, I was writing down the stress test, and I wrote down the 5%. They'll look at the 5% less occupancy.
Mhm.
But what were the other two?
Oh, yeah. So the stress test 5% vacancy. They'll drop the or they'll add a 5% vacancy factor. They'll add 10% to insurance. So just in case that, that's a fee that could potentially go up year over year. So they'll stress test it by 10%. And the other thing that they'll do is they will add what's called a replacement reserve. And normally the way they'll
150 for every unit.
Yep, exactly.
And that's deducted from the net operating.
Yep, they'll remove that from the NOI, from the net operating income, and basically stress test it another way.
Thank you.
And then one piece of information I think is probably it's interesting and probably pretty pertinent now that rates are climbing is these loans are assumable, which that's that's something that's just really important, especially if if we're working with a client that is purchasing a multifamily property, that they're aware of that. It's would love to do every deal and have their business, but at the same time, it's probably the right thing to do to make sure that they're aware that that the loan that's on the property might be assumable for a 1% fee. That means that they could keep that same rate. So if they're buying something that's got a like Eli is stating early in that video that rates at the 3.5 mark, if they could get a rate at 3.5 versus 4.5 or 5%, that's a pretty big win for a 1% fee, especially if they're going to have that loan for more than 1 year. Obviously, one year they say that 1% pretty quick after that. So but yeah, I think that's pretty much most of the information I wanted to cover on the Freddie Fannie loans. Any questions that you guys have on those?
I have a few.
Mhm.
So starting with the rates, I know that it can be fixed for the 5, 7, and 10 year, and then the 20 year can be blended. So would that mean like they're locking the rate on the day of, I think they said whenever when it's signed, the commitment
Sure.
is
Yep.
signed, that rate would be for the first, like, for example, like the 7 to 13, that would be for the first 7 years. And then once you get to that like 8th year, would that be like, how would the rate begin to adjust? Like, would it be like with the market on the 8th year, or would it kind of like slowly increase, or?
No, yeah, I see what you're saying. So yeah, it's that day, it's a new rate. So based on what the market rates are at the time, so it could move quite a bit. That's why long-term rate locks are important. And if you get a loan that's got a 10-year lock versus a 5-year, you normally pay a premium on it, through the loan, through the loan rate itself. But that peace of mind could definitely be worth it. I think right now the difference on the rates is, I think, 4.5-ish for a 5-year, and I think they're at a bit over 5 for the 10-year locks right now. So there's it's quite a bit more.
So for example, like say, just for number wise, say they started with like a fixed rate that was 2%, and then they went through those 7 years, and then the market jumped to like 6% at the 8th year. Would they be paying 6% on that 8th year?
Yep. Oh yeah, yep. It goes with the new market rates. There's no kind of like steady increase to it or anything like that. So yep.
Be very fingers crossed for the 8th year.
Yeah, yes. Yeah, very much so. And sometimes groups will plan around that, and they'll know that they only plan on holding on to the property for 5 years, or they plan on holding on to it for 7 years or 10, and they will that's why they'll go for those rate locks. And the other option is they'll have a window where they know where the rates are going to be when it gets to the end of the year for your rate lock. You've really got 12 months to get out of the loan, which may be a refinance, it may be selling it, it could be any number of things, but there's definitely some time, so at least they know from the day they sign the documents how long they've got. So
sorry, I have more questions. I'm just writing that.
no, go for it. Yep. How about you, Will? Any questions on your side?
Yeah, I did have one.
Sure.
I didn't hear anything about it, but do Fannie and Freddie loans, like, do they dip into any construction loans, or do they kind of stay away from that?
It's going to be all built properties, no construction, and because they're going to want to have that 90% occupied aspect to it. So yeah, normally the way it would work, you would go and you have a bridge loan or a construction loan. And then once the property is built, depending on your, where the initial financing or the initial construction financing, let's say the construction financing is for 36 months, and it gives time for construction and ramp up in occupancy, then you might be able to go straight from your construction loan to a Freddie or Fannie loan. The other option is if you've got a construction loan, let's say it's 18 months and you've got everything built, but you're not quite fully occupied. There are some lenders that'll do bridge loans for, it's basically it's a product designed to bridge it from construction to Freddie and Fannie lending, where they know that it's going to qualify for it, but it's just not quite there yet. So some of the Freddie and Fannie lenders will offer that sort of financing, bridge to Freddie, bridge to Fannie sort of product.
Thank you.
Yep.
On the interest only offered, I know we've
Mhm.
In the past videos we've talked about like what that means civilly, but I can't. I guess I just haven't wrapped my head around it yet. So in the video it said that it was like 4 basis points per year that the client would pay to have that interest only. Is that? Could you explain that sort of to me?
Yeah, so it would normally come in as a bump to the rate is normally the way it would work. If there's an interest only period, they charge a higher interest rate, but you wouldn't be paying principal. So there would be, if it's a 4 basis point bump, it would be a 0.4 increase on the rate, and then you'd only be paying the interest payment, and it's there to for the to make it affordable for the borrower, to drive that whole affordable housing kind of aspect of it, if they can keep the payments down. And sometimes it's just a case of the property's not quite cash flowing where it needs to be, or give a little bit of a cushion to the borrower to get it to a point where they're comfortable making the principal and interest payment. There could be any variety of reasons where they might choose to do that for a period of the loan. But yeah, they pay a premium on it. So
Okay, so that 4 basis points is 0.4 increase on the rate.
Mhm.
So if the rate was 3, then it would become 3.4.
correct. Yep.
Okay.
Yep. All right. Well, any other questions on your side?
I don't think I have anything.
Cool.
I have one more.
For me,
You're out of questions, Lana. It's Will's turn.
I'm a question
yeah.
girl.
That's fine.
No, I do not have anything. For me, I just need to take a couple of days to process it, like go
Sure.
through it again, and I'll really lock it in my mind. But everything you said was super helpful, so thank you
Cool.
again.
Okay, good, great. All right, Lana, fire away.
I think this is my last one, but I've been wrong before. So
you're free to ask as many as you want.
The cash out designation.
Oh, yeah.
That's I'm totally confused on.
Mhm.
I have that it's designated as anything over 3% back to the borrower after
Yep.
closing costs, and that's the majority of what's going on. And I understand, like, yeah, I if you could just explain, because I kind of I understand, but I could also be totally wrong.
Sure. So they kind of put that 3% buffer in there just to prevent them from having to keep going back to the drawing board, is really what it comes down to. But they will allow you to pay closing costs in the Freddie Fannie loan. So if you're paying off a loan of let's say $1 million, and that's the refi amount, they'll finance 1 million, 10,000, something like that, and then that 10,000 is there for title fees, maybe cover some attorney stuff or whatever, notary fees, insurance, premium, if that needs to be included in there. So you can cover some of the closing costs, or you can cover the closing costs in the Freddie Fannie loan. Now, if that money going back to the client, and they target, they try to target the exact amount, but if there's an amount that goes back to the client beyond 3% of the loan amount, then that gets looked at as a cash out loan, and it's a different
So
pricing model.
when you say going back to the client, like, does that mean like that 10,000 that you're
Mhm.
talking about, that is what we're calling the percentage of the loan?
Well, yeah. So if it's at the end of the day, on the settlement statement for the loan, it's going to show like a payoff to the um, the previous lender of $1 million, and then there's going to show, say 2,500 going to the title company for the title policy. There's going to be 2,500 going towards attorney fees for closing, and then so we've now got $5,000 left in our loan. That 5,000 is going back to the client. So
Okay.
if that amount that's at the at the end of the day is going back to the client is greater than 3%, it gets looked at as a cash out loan. So in that scenario, it would just be a 5,000 going back to the client, and it's like, okay, no worries. If that scenario, if they were ending up with like 40, 50,000 going back to them, then it's now become a cash out loan, and it goes through a different pricing model. So there's higher rates to be paid, things like that. There's different, there may be some different underwriting parameters, things like that. They might look at it a little bit differently. So they just allow a little bit of wiggle room in there because they don't want to have to sit there and count up every like nickel and dime that's going out and then try and hit the target, 100%. They just feel as though 3% is enough wiggle room to make it work.
Okay, so just making sure I got it clear. So when the loan comes, it
Mhm.
goes to, like fees and attorneys and, like actually purchasing
Mhm.
whatever's being purchased.
Mhm.
And then whatever is left over after everyone but the client has gotten any money, that is what's like going back to the client. And then when that is greater than 3% of the total of the loan, then it
Mhm.
becomes a cash out. And so then
Mhm.
that's when the credit overlays on the cash outs. Oh, wait. Yeah. The credit
Mhm.
overlays on cash out refinance come in, and they're asking like 5% on LTV and 10 basis points on debt service coverage ratio.
Exactly. Yep. 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 You got it. Cool.
Okay. I think I still think that was my last question, but see you later.
No worries if you got more. Cool. Well, I'm going to wrap up our recording here then. And then we've got about 8 minutes, so we will not get into life co-loans today. So